pretty dire outlook there from the Dallas Fed, saying they think that a global slowdown is unavoidable. What do you think?
Well, look, if you think about Russia and Ukraine as one region in terms of commodity exports, it's clearly one of the largest commodity exporters in the world. The exact extent of how much exports will be lost in various categories is unclear, but it can have a multi-year impact. Think about agriculture, for example. There have been sort of very, very sad, clear indications that this can lead to crop shortages in big parts of the world. There's a lot of fungibility in these commodities, and it means they will all rise together. And it's not something that's suddenly the planning season for 2022 is going to resolve. So replacing lost commodity output is going to be a big struggle. And it's something that, again, the world needs to do to adjust to this. But just like COVID, again, it's shown the ability to adapt to a changing situation. The world economy showed a very good ability to do that. And I wouldn't be hopeless around that.
Yeah, but like COVID was very different, right? COVID, we had this global problem. The government shut down everything. The Fed threw a bunch of money at things because the government shut it down. We all kind of moved in the same direction. This is totally different, it feels like, Stephen, because on one hand, you've got raging inflation out of control, some of which no doubt is caused by what's going on in Ukraine. But at the same time, a Federal Reserve facing these inflation shocks and the real threat of a slowdown and talking about raising rates aggressively. One could almost see an environment where they should be talking about cutting rates, not raising them, despite inflation. I can see it both ways.
So definitely, Brian, if you just think about this, the Federal Reserve, with all of its new tough talk on inflation, has been doing a QE program into this month, right? So they were easing in a boom last year, and they're going to tighten to a slowdown. We think that this is going to argue for more conservative investment portfolios. Clearly, when you take a look on your screen, it shows the 5-year note yield up to 236. Again, that's for all 5 years. It's not just for the short period of time. And again, we've reallocated quite a bit, again, to these more conservative investments. We think, again, that out of the cyclical industries, the natural resources industries will be the ones that are going to get a very big shift upwards in the demand curve. But this is a very different environment than we were when it was all easing. So again, the Fed's tightening into a slowing economy. Just think about the powerful case of what's happened with federal spending. It's down 22% this year. That's a different environment than what we had last year when the Fed was easing.
What's going to happen with housing? Because I think that's going to be the driver, at least in America, for everything. And housing doesn't look good.
Well, look, we just had a very big leap in housing related to pandemic shifts. I do think people will sort of argue that the rate impact alone will knock it down. I think some of these shifts to the south in the United States are going to be fairly durable. But there's a great deal of growth. Again, last year's nearly 6% growth rate, a great deal of that will be absent. And the Federal Reserve a year from now is going to say, well, wait a second, we tightened into a slowdown.